Welcome everyone to the webinar on tools for success in today's biodiesel market. My name is Gerald Kootenay. I'm the Executive Vice President and the Director of the Emerging Technologies Group of Lee Enterprises Consulting. I'm filling in for Wayne Lee, the CEO of our group, who sends his apologies for missing this event. Lee Enterprises Consulting is the world's largest alternative and renewable fuels consulting group, with experts in North America, Europe, Australia, and Asia. We have in-depth expertise in all aspects of biodiesel, ethanol, solar, wind, and emerging technologies. We also maintain ongoing strategic relationships with the industry's top law firms, accounting groups, engineering groups, technology providers, and fabrication facilities. We have 5 teams: biodiesel, ethanol, emerging technologies, wind solar, and business financial. We have over 50 experts from a variety of disciplines and backgrounds. Here is a list of our services, which of course I don't expect you to read, and it's not complete in any case, as every day we get unique requests on a daily basis. If you go to our website, you will see a list of services under each division. In addition to the consultants, we have a number of strategic alliances with leading businesses in the sector, including Genscape, FC Stone, Tenaska, Murex, ICM, ERI, and IMA Insurance. We also have 2 large law firms and 2 accounting firms and some manufacturing groups that are within our group. The bottom line is that we provide a full spectrum of services for new projects and established facilities alike. In any kind of alternative or renewable project or facility, we aim to be the first call from our clients. Today's webinar is being brought to you by our biodiesel division, headed by Susan Olson of Genscape, who will be your host for today's call. And we would like to thank Genscape for putting this together for us. During the presentations, if you have questions, please fill in the marked box at the bottom of the slide marked Q&A. These questions will be addressed at the end of the presentation. If we run out of time, the experts will get back to you by email after the presentations are over. And today's speakers include Scott Bunce, assessing the economics of the industry, Jake Moline, filling in for Nate Burke on locking in forward margins, Kathy Rain,
Hey, Caitlin, this is Susan Olson. Can you hear me?
I can, yes.
Okay, great. Hey, sorry everybody for the cut in there. I think we lost Gerald there, so just wanted to. I'm sure he was introducing me in the pause there. I'm Susan Olson. I'll be your host today. I just want to thank Wayne and Lee Enterprises and Gerald for inviting Genscape here today. My background is in research and development, and I'm the VP of biofuels here at Genscape. So I'll be the host, so I'll just be introducing the speakers as they come along here, and also be speaking myself a little bit during the talk today. So without further ado, I thought I would go ahead and introduce our first speaker today, Scott Bunce from Tenaska Commodities. He's got a lot of experience in business development and risk management and trading, and he's going to share some of the expertise with us today related to biodiesel. He has some very exciting information to present to everyone today, talking about margins and feedstocks and the real nuts and bolts of how the pricing and value gets put together. So he's worked with some great firms, Conagra and Gavilon, before he came to Tenaska, and has a lot of experience with a variety of different commodities. So with that, Scott, I'll flip it over to you to get started on your talk today.
Thanks, Susan. I appreciate it, and thanks for Lee Enterprises for putting this together along with you guys today. I think I might have possibly drawn the short straw out of this one because there are exciting things to talk about in biodiesel, but it's also a very challenging environment. So there's some difficult things going on in the industry, but there's a few lights at the end of the tunnel as well that we'll get to here in a couple of minutes. But really, the thing with biodiesel is that it's driven by many different moving parts of the commodity markets. You've got energy prices, which are a main driver of our final product. You've got imported biodiesel, looking at the economics of the world industry. RINs prices and LCFS credits are a complicated portion of what we do. Biggest driver is feedstock prices, the varying feedstocks that can go into biodiesel. Then you've got things like policy, the RFS program, and a tax credit situation. As we've been aware that the tax credit has expired 4 of the last 6 years, and then has been retroacted as well. So policy uncertainty and many moving commodity pieces can make biodiesel a challenging market to manage from a risk perspective. The biggest driver for us in the marketplace today, and it has been for the last year, is what's happened with crude oil and heating oil. We have seen crude oil prices drop about 51% year to date. That has also driven down heating oil and down about 42% year to date as well. And this is a major change in the world. Fracking has been a game changer not only in the U.S. but for world oil prices, and U.S. production is now more certain than it's ever been. The reason this is all important is heating oil is really a key component in when you're managing margin for biodiesel, and it's put a lot of pressure onto blend margins for the industry. You'll hear a lot of people talk about the BOHO spread. That's the spread between what soybean oil and heating oil is from a financial standpoint. I don't want to steal any of Jake's thunder that's coming up here next, but if you look at this chart, sometimes it's difficult to interpret, but the higher the number, the less the margin is in the industry. We would prefer something below the 0 mark. That would show that the feedstock is cheaper than the end product, because biodiesel trades as a basis to a heating oil or ULSD. The feedstocks are soybean oil or similar products, and typically the industry will use soybean oil to hedge the front end and the feedstock side. We spent a lot of time in negative territory this year for the producer, and typically you would see a D4 RIN or the biodiesel RIN offset a higher spread on the BOHO, but this hasn't materialized this year because plants have been running at a higher pace than what the margins would say they might be. In 2014, we had some time where the spread was favorable, but we have not seen it yet in 2015. Another big impact this year and going forward is going to be biodiesel imports. Foreign competition has definitely increased. Palmethyl ester has been coming to the U.S. for several years. You can't generate a RIN from PME, but they've been able to take advantage of the biodiesel tax credit. But there's been some changes between European policy and U.S. policy and commodity economics for the feedstocks. We've seen a lot of Argentinian biodiesel move to the U.S. This year as well. Argentina incentivizes bio-exports through lower taxes that are relative to what they can export their soybean oil for. And now the EPA has granted them the ability to generate a RIN. Also, the U.S. dollar has been very strong versus the Argentinian peso, and that strength creates incentive for exports. There's estimates that up to 600 million gallons per year can come in from Argentina. This year we've seen about 260 million gallons through September. We expect that in Q4 we could accelerate that even more as they try and take advantage of a potential retroactive blender's tax credit. Another key component is RINs. Obviously, if you look at this chart, the RINs have been volatile this year. We've got a little bit of movement higher after the RFS came out with their new proposed numbers, but now we've had a sharp fall since that time. To this point, about 1.35 billion gallons of the 1.7 billion gallon 2015 mandate has been generated, and we're projecting somewhere around 1.85 to 1.9 being generated for 2015. That also means we'll have the ability to carry over some RINs versus the 2016 mandate. There's a relationship with the D4 RINs versus the D5s and D6s for advanced and for ethanol. We're seeing some Brazilian ethanol imports coming to the U.S. now as well, and some cellulosic production. That fills the total advanced bucket, which the biodiesel industry had hoped that biodiesel would fill more of that bucket, so been some other imports affecting us there. We have seen the D4s move higher recently. This chart's actually a little bit out of date. It's closer to 60 on the RINs now. We hear from the EPA that there will be adjustments to the May 29th RVO proposal. I think the market is, one, anticipating the slightly higher numbers for the cellulosic and advanced category, and also potentially a little bit higher on biodiesel. Whether they'll take imported volume into account from Argentina is yet to be seen. Feedstocks is the largest cost of a biodiesel plant. We've got four to five main feedstocks. Soybean oil, which is the largest. Distillers corn oil has become more pronounced in the last several years. It's a good quality feedstock for people that can use it. Used cooking oil and yellow grease, an abundant supply of that, can be variable in quality, and animal fats. And really the different feedstocks, you change usage based on price, but also on technology. Not every plant has the ability to use the distillers corn oil or UCO or animal fats that are higher FFA, or the distillation technology maybe for a corn oil application. In this area, renewable diesel tends to be pretty flexible. They can use all of these products. Soybean oil is still king. The integrated crushers / biodiesel producers still use a lot of soybean oil. The other areas, corn oil and UCO and yellow, have been growing slightly as more plants put in the technology to be able to use them. There are incentives to use these lower quality feedstocks because of price. This is a good indication of the overall price movement. We have seen lower feedstock prices. There's not a strong correlation between all of these different products, but in general, as soybean oil moves lower, so do the other products. There's a good U.S. soybean crop this year, a good harvest. We expect soybean oil ending stocks to be higher at year end. The unfortunate thing is that soybean oil prices haven't moved down as quickly as the biodiesel price has. With all that being said, our production is still fairly high. We're maintaining a high pace this year. Basically what's happening is the well-capitalized plants continue to run even at a negative margin in anticipation of a retroactive tax credit coming back in. And we still have plenty of capacity in the industry to meet the mandates. We're only producing, as you can see here, we've got the ability to go up over to close to 2 billion gallons, and we're not close to that today. So this leads to the biodiesel margin. We're spending an awful lot of time here around zero or negative. It's not a very good picture when you take all these different factors into account. We've got about 40 to 60 cents, of plant cost depending on efficiency and size of the operation. So it's not an exact science, but this all adds up to a fairly difficult environment that we've had. On the positive front, LCFS, the California program, we've seen LCFS credits rise very quickly here in the last few months. This chart also needs to be updated. We're closer to $75 or $80 for the credits today. The readoption of the California LCFS program has firmed the market out there. Obligated parties seem to be taking note. They're managing their business to the policy. California is a huge market for biodiesel. It appears that this LCFS program is going to stay in place and strong for years to come. We also see opportunities in Oregon, Washington, and British Columbia, and this really could be a game changer future for the business out there as people, as these local states or the state governments take these programs and continue to support them. Just for reference sake, an $80 LCFS credit can add up to about 95 cents a gallon on your biodiesel margin if you're using a corn oil with a 4CI. The downside is that you'll still possibly see imports into the West Coast even without a biodiesel blender's tax credit, because the LCFS credits are valuable. So just to kind of wrap up my piece here and keep us on time, the outlook, we've got an abundance of commodities. The good thing is we have abundance of commodities on feedstock, but we also have an abundance of crude oil, thus heating oil, and so that's going to be a challenge for the industry going forward. RFS, we finally look like we have some multi-year direction, a little more vision to that path than we've had in years past. But everybody's wondering about the biodiesel tax credit. My personal opinion is I think we get a retroactive tax credit this year. I think the industry believes we get a tax credit this year. Next year, I don't know. I would say that they will kick the can down the road again and probably not give us that. Should they do it, the momentum for producers' tax credit is there, and I think it's got significant momentum, and it would be a game changer for the industry. It would challenge the imports. And LCFS, there has been some further calculations on the values that they use out there for the various feedstocks. It's leveled the playing field a little bit, but it's also helped firm the program overall and help make it more long term. It's right now it's set to be a base for the market going forward. Hopefully next time we do one of these, I will have a lot of great margin information to share and talk about how much money everybody's making. But I know we're going to have some questions at the end, and with that, I'll turn it back over to Susan.
Thanks a lot, Scott. I appreciate that. That's very helpful for you to share that information with everybody today. And we've had a couple of questions come through. Really, we'd love to get questions from our attendees today. That really helps us provide some color at the end of the presentation. So if you have any questions related to Scott's presentation that are on your mind now, go ahead and type those in. We'll answer those anonymously at the end of the presentation. If we don't get to all of them, don't worry. We'll answer them. Individuals will answer them from the panel today directly to the person that asked the question. So next up we have FC Stone, and unfortunately Nate was unable to make it today, but we have Jake Moline here with us, who is also a risk management consultant at FC Stone. He's been at the firm for the past 4 years. He's helped a lot of biodiesel producers help do their hedging. So Jake, I'd just like to flip it over to you, and you can get started on your section of the panel.
Thank you very much, Susan. I'd like to once again thank Lee Enterprises for asking us to participate here. I know Nate wanted to be here, but he's got a pretty important life moment going on here, the birth of his second and third daughters, actually. So very important thing to be present for, thus, me filling in here for him. I have been working here at FC Stone for about 4 years. Used to be a little more involved in the biodiesel portion of the business, but still have a pretty good idea of the fundamentals and mechanics of how we like to look at hedging for plants, and that's kind of what we're going to walk through, more the mechanics side of this thing, as Scott kind of alluded to in the previous few slides here. There's numerous factors in determining biodiesel margins, and there's no shortage of volatility. That's kind of where we like to pride ourselves on, is taking away a little bit of that risk for the plant. And we're just going to get through some of the terms here. Got our disclaimer. These first few slides here, terminology, we're not going to walk through this. This will be available after the presentation. But as I'm walking through, if we're going through any of these terms and you have a question on what that means, we do like to look at things in terms of a HOBO spread rather than a BOHO, meaning a positive margin would indicate a positive net margin back to the plant. We're going to walk through a few of the different ways that you can lock in a biodiesel margin. There's basically two different ways of thought here when it comes to protecting or not protecting against swings in the market. You can either stay open to the market, be a market taker. In that case, you're willing to let it ride on a daily basis and take whatever margin the market were to give to you. We like to approach things more as a market maker, where you lock in forward margins via hedging futures and give yourself a little bit of a budget to work with. We're going to walk through exactly how to do that. There's basically two main pieces to a biodiesel margin, and that's the product, or biodiesel, and the feedstock, usually soybean oil. But as Scott said, there's various different feedstocks involved. Can all be hedged, though. First example we're going to walk through is an example where a plant can sell flat price biodiesel for 2 months forward, but is unable to lock in the flat price feedstock for 2 months forward. In this example, they can buy soybean oil from a soy crush plant for 1 month out forward, but past that, and this is a common thing in the industry, crush plants, feedstock traders prefer to sell as a basis to soybean oil further than 1 month out. For that reason, you have to incorporate futures into your hedging plan. So we've got 1 million gallons a month of biodiesel here sold at $2.75 for the next 2 months. The soy crush plant is willing to sell us 1 month of soybean oil at 28 cents per pound. Nearby soybean oil futures are trading at 27 cents per pound, and the soy crush plant offers to sell you 1 cent over basis for the second month here. We're going to utilize operating costs of 60 cents a gallon here to lock in margins for the 2-month strip. I apologize there for the dog. I don't know who that is. If you could please mute your phone. To lock in margins for the 2-month strip, we're going to have the biodiesel producer book that 1 cent over basis with the soy crush plant. For month 2, simultaneously, we're going to need to go long futures in order to protect against that price from rising higher. So we've got 1 million gallons of biodiesel, 7.5 pounds a gallon there of the feedstock, equals 7.5 million, divided by 60,000, which is the contract size of a soybean oil futures, and that equals 125 contracts. We would go long 125 contracts, and by booking that basis, we've essentially locked in a flat price feedstock. Slide here. So we've got the transaction here where we sold the biodiesel, bought the flat price soybean oil, and went long 125 contracts of soybean oil at a 1 cent over basis. By doing this, we've essentially locked in a margin here. You got the 275 minus the 28 cents per pound times 7.5 plus the 60 equals 5 cents a gallon net margin. To flat price the second month of soybean oil. Basically what we would do is exchange futures ahead of the month of delivery, so say 5 days prior to the start of the month 2. If the market were to trade 5 cents higher from the time of the futures and basis were locked in to the time they price month 2, the producer would pay 33 cents for the physical soybean oil. At the same time the physical soybean oil is priced for month 2, the producer would liquidate or sell the futures contract, oftentimes exchange, and collect 5 cents a pound. We're going to look at how that plays out and how the physical and financial positions would offset each other. So here we've got cash soybean oil at 28 cents a pound in October. The futures at 27 cents a pound. The basis 1 over as we spoke about. By the time December rolls around, we've got the cash soybean oil at 33 cents a pound. The futures are now at 32. So we have a 5 cent physical loss that's completely offset by the 5 cent financial gain. Same principle here on the biodiesel side. Let's look at an example where a plant is able to book in physical soybean oil for the full 2 months out forward, but unable to sell their biodiesel for the second month. So we've bought 1,000 gallons a month, or 15 million pounds of soybean oil at 28 cents for 2 months. The biodiesel offtake will buy the first month at $2.75 flat price, but for the second month, they'll buy it at $1.25 over heating oil, or basis over heating oil. Biodiesel operating cost, once again, 60 cents a gallon here. We're going to go through this example a little bit quicker, but instead of going long futures, we're going to sell heating oil futures to protect against the price from going down. I'm going to move to the next slide here. You can see in the equation down below here, we've got the 275 minus the 28 times 7.5 plus the 60, same margin here. Just like with the soybean oil, you'll exchange futures or liquidate your hedge prior to that month of delivery. We're going to look at how that looks here in the example. So in October, we've got cash biodiesel at $2.75, the futures at $2.50, $1.25 over. December, $2.55 cash, futures at $2.30. We've got a net physical loss of 20 cents, completely offset by the physical gain of 20 cents. And then as we're kind of moving into our next speaker here, financing, margining a hedged position can add up here, which brings in the importance of having a financing program in place. Soybean oil, the initial margin is $950 a contract. Once again, the contract size for soybean oil is 60,000 pounds. Heating oil, $5,200 a contract for a 42,000 gallon contract. Maintenance margin slightly lower here, which would come into play for most often for hedgers as well. Would utilize the maintenance margin rather than the initial margin. $600 a contract or $420 a contract for the heating oil. We've got some helpful tables here that explain the capital requirements for hedging soybean oil. So in this example, we've got the million gallons once again, or 7,500,000 pounds of feedstock usage. That's 125 contracts at the $950 for initial margin. You can see what it would cost to hedge 100% of your production all the way down to 25, and then for every penny per pound move in that soybean oil futures, that's the incremental additional margin that would be required. So you can see that, with volatile markets, this can add up quickly. Same thing on the biodiesel side. This time we're looking at 24 contracts to hedge 100% of your million gallons there. You've got just under $125,000 in initial margin for every 5-cent move. In heating oil, you're looking at about another $50,000 in a maintenance margin that's required that the market goes against you there. So definitely something that costs a lot of money to hedge, but as we showed in the previous examples, completely offset by either a physical gain if you have a financial loss, or if you had a financial gain, that would be offset by a physical loss. And we think it's a very important thing to look at in extremely volatile markets. So with that, I'm going to kick it back to Susan here.
Thanks a lot, Jake. I appreciate you making the time with us today, and it's very it's refreshing to see a transparent view and the explanation of hedging like that. I know that I got a lot out of it, and hope our audience did as well. So I'm sure there'll be some questions here at the end. And I'd like to introduce our next speaker, Kathy Ryan, who owns Sandalwood Valuation. She's an accredited appraiser, and she's performed numerous appraisals of alternative fuels plants and the machinery and equipment that they hold. She's going to talk to us today about financing in the biodiesel industry and bringing her experience to the table here. So, Kathy, I'll flip it over to you for the next part of our panel.
Sounds great. Thank you so much, Susan. I appreciate the introduction, and also thanks to Lee Enterprises. So the experts on our business and finance team work with startup entities quite often, and what we've found is that many projects have management teams who want to skip ahead and go straight to construction and operation. This slide that talks about the startup stages outlines the important steps needed to secure funding. Our team can assist not only in making the introductions to investors, but also in making sure that everything is ready before sitting down and pitching your project to those investors. We can assist in several important steps, including feasibility studies and detailed business plans. Risk identification is a key part of preparing your project for financing discussions. I'll introduce Jeff Kistner's background later, but he and our other funding experts can assist you in identifying and mitigating risk. This slide is a quick guide to remembering what it takes to attract financing. The 5 C's are what our team focuses on: character, collateral, capital, capacity, and conditions. So in addition to my expertise in doing the equipment and machinery equipment appraisals, I'd like to also introduce some of the other experts on our team. Mindy Collier is our grant writer and researcher. She's written 5 successful grant applications under USDA programs, totaling over $1 million for projects based in 4 different states. Mindy wanted me to remind everyone on the program that the deadline for the 2016 grant applications is May 2nd, so it's time to get those applications started. On the next slide, Jeff Kistner is our funding expert, both at the pilot funding stage and higher. He successfully raised over $1 billion for the construction of renewable energy plants over the past 10 years. His expertise includes funding for the early stages of development, PP&E, and operating capital. In addition to Lee Enterprises Consulting's ongoing support of clients in plant management, engineering, accounting, and asset management, our legal partners at Sullivan & Worcester in Washington, D.C. serve clients who invest and participate in the energy markets, particularly in clean and renewable energy transactions. Their clients are engaged in virtually all aspects of investment and energy industries, from equity investors, tax equity investors, and lenders to project developers, hedging counterparties, energy companies, and other industry leaders. Client projects, which vary in size from small scale to utility scale, cut across a wide range of energy sectors, including biofuels. We work closely with attorneys Eli Hinckley, Jim Rathall, and Van Hildebrand at the firm. Some recent examples of Sullivan Worcester's work includes they represented an energy investment and management company in its acquisition of several food waste to energy power facilities, which range from 3 to 5 megawatts each. They represented a biofuels refining and trading company in disputes arising out of allegedly fraudulent credits generated under EPA's RFS program, and they represented a major trade association in litigation challenging EPA's RFS rulemaking. So, Susan, I'll hand this back to you. Thank you.
Thanks, Kathy. Appreciate that. And if anybody has any questions out there about biodiesel financing, please ask those, and Kathy will be happy to answer them at the end of the presentation. So today, what I'm going to talk about, we've talked a little bit about the financial aspects, and what I'll be talking about is really more of the supply and demand aspects of biodiesel, especially as it relates to the renewable fuel standard, and I'll look at basically the biomass-based diesel industry performance to date, and then some forward-looking perspective. Just a few words about Genscape and why we're a part of Lee Enterprises. Our mission is really to promote market transparency and efficiency in energy and commodity trades, and we do this by providing better information that in many cases industries have not been able to see before. And so we provide this type of information in power, natural gas, NGLs, oil, solar. We also do this in maritime shipping, water, and of course, biofuels. So we also have a successful RFS2 QAP program with participants from every fuel type. We do engineering review services with some of our partners for Lee Enterprises. We also have an emerging LCFS credit integrity program that's starting to be very popular, and we do land use verification. But Today's presentation will really be talking about what we've learned from research recently from our supply and demand type information services, specifically focusing on biodiesel. And so today, this is how the short time with you I have today will go. We'll talk about the role of U.S. biodiesel production in meeting RFS2, also the important role of renewable diesel and how that factors into the D4 equation in terms of RINs. We'll talk about net imports, and then actually I'll carve out some dedicated time to talk about U.S. imports coming in from Argentina with the Carbio survey program that Scott mentioned earlier coming into effect. That's had an impact on imports in 2015, and so we want to take some time to look at those in detail. And then I'll present a forward-looking summary, kind of where we are today in meeting the mandate. So one thing I want to mention as we get started here is that all of us prepared our slides ahead of time. There is some EPA RFS2 data that's come out this week for September 2015. This data that I'm going to show you today will cover the EPA's data up to August 2015. We haven't had time to incorporate that yet into this analysis. So Genscape will be following up in November, and I'll let you all know about that when we have the details that include September and possibly the October data from the EPA. So let's talk about the baseline year to date. This graph should look familiar. Scott presented this graph. This is the EPA's U.S. monthly biodiesel production from 2013 to 2015 on a monthly basis. And I just wanted to talk about a few things here. Year to date, the EIA shows domestic production through July 2015 at about 715 million gallons. So if you look at 2013 and 2014, you'll see a lot of similarity there in terms of how the biodiesel production progressed over the months and also just the general levels. And 2013 was actually a forward tax credit looking year. 2014 was a retroactive tax credit looking year. And then 2015 so far we have nothing. And as Scott mentioned, the market conditions have not been good this year in a lot of the months. But production to date has actually slightly exceeded both the 2013 and 2014 years. So the industry has actually produced more this year. And based on the production dynamics in 2014, which are not dissimilar to other production years, we would expect about 600 million more gallons to be produced August through December in terms of the statistics. Of course, August and September and part of November and October have already happened, but statistically somewhere around 1.3 million gallons by the end of the year. As you can see from the graph, a lot of biodiesel is typically produced in the latter half of the year compared to the former. So biodiesel is not the only contributor. Let me go back a slide here. Biodiesel is not the only contributor to the biomass-based diesel RIN pool that's part of RFS. Renewable diesel also plays a significant factor in that. As you can see, we're running at a rate of about 20% based on the EPA's EMTS data through August, and that's not at all dissimilar to what we saw in 2013. Actually, I wanted to mention that there's been some growth in 2013. The fraction of renewable diesel was about 15%. So we've grown a little bit in 2014 and very similar performance so far year to date this year. So the renewable diesel that's coming into the United States, there's some domestic supply and there's also import supply. Scott mentioned that briefly in his talk, and so I wanted to talk about how this plays a role in RFS. So some of this renewable diesel that's coming in actually that's qualifies for D6 RINs. So I wanted to talk about that first. So you see here this chart directly pulled from the EPA's EMTS data showing the different categories of RINs for non-ester renewable diesel with an equivalence value of 1.7. So the D6 RINs could have only come from two facilities based on Part 80's fuel list registrants. The Neste Singapore and Finland facilities are the only ones that are registered to produce D6 RINs. So there's been about 130 million gallons of this fuel that's D6 qualified through August based on EMTS records. And usually a facility like Neste is qualified for both D4 and D6. And when it's D6, it's a palm-based product. The feedstock is actually what makes it The feedstock is actually what makes it qualified as a D6 RIN product rather than a D4. So, and that's not the only material that's come in from Neste. We've actually seen from our own records about 168 million gallons being shipped here to the United States from Singapore. And there's also another 61 million gallons that have been applied by EMTS records that are not indicated yet by shipping records. And so there are several reasons why that could be. One of those reasons is that it could have that Neste is most likely a foreign RIN generator, which means they generate RINs upon production, and it can take some time to get a ship. Then it takes about 30 days or so for the fuel to actually get here once it is shipped. It could have been shipped by another party. It could have been blended or reported to U.S. Customs differently. But all in all, there is more D4 gallons indicated by EMTS records than shown by physical shipment. So let's talk about the D4 qualified portion of the renewable diesel that's part of the RFS pool. There's about 213 million gallons in total. The table below that shows all the different companies that are registered as part of the Part 80 fuels list to produce EV 1.7 renewable diesel with a RIN code of D4. So based on Genscape's research, the three with the dots there are the ones that look to have been producing renewable diesel in 2015. That's Diamond Green Diesel, Neste in Singapore, and the REG Geismar facility, which is in a restart mode. Altair also may be active, but it looks like they're focusing on jet fuel rather than renewable diesel insofar. So we've talked about domestic production. We've talked about renewable diesel, both coming in for D6 and then also coming in for D4, and then also talked about renewable diesel as part of the domestic pool. So now I wanted to focus on imported biodiesel. This chart is just it's an EIA database chart that shows biodiesel imports through the EIA survey months through July 2015, and you can see the different countries that we imported biodiesel from through the summer. So the Indonesian shipments you see there, Genscape has determined that according to U.S. Customs records, those are almost all palm methyl ester, and so you can expect the majority of the biodiesel coming in from Indonesia is going to qualify for D6 RINs rather than D4 RINs. Argentina and Canada are the main contributors to the D4 RIN pool for RFS. So excluding Indonesia, you can see there's about 101 million gallons through July 2015 based on EIA data. The census data reports another 29 million gallons coming in of D4 qualified biodiesel for August. And we'll show a little bit more in depth about Argentina in the future slides. So breaking this all down, here are the contributions by fuel source and import versus domestic. So you've got about 70% of the biodiesel coming in, or 70% of the biodiesel qualified for RFS2 is actually domestic biodiesel. And then the other sources are, about 10% each, more or less, from imported biodiesel, domestic renewable diesel, and also imported renewable diesel. And you can look at that by gallons as well, and this will be part of the slide deck I believe you'll be able to download at the end of the presentation. So quickly, I want to look at U.S. imports from Argentina, and then I'll wrap it up with just a quick summary of the supply balance for the RFS2 D4 category. Genscape actually electronically tracks vessels crossing into areas and ports of interest to capture what's coming in from Argentina. So the picture you see there is actually the San Lorenzo Rosario area where most of the biodiesel comes from Argentina to the United States, and shows those blue boundaries there where we actually watch specific ports and berths for vessels that are leaving. We actually, in addition to watching vessels in those areas, we determine product type that are carried by these chemical bulk tankers by looking at the characteristics of the berth where the ship leaves, draft changes, available port data, and destination. So we continue to watch that ship through its journey to forecast the arrival date, and then where it lands to forecast what's on the ship, and also we look at the U.S. Customs records. The snapshot you see is one of the things our analysts use. This is a vessel tracker. It's a company that's owned by Genscape. It's the largest AIS antenna network in the world, and we also supplement that with satellite data to track ships of all types, from fishing vessels to yachts to chemical bulk tankers to crude oil tankers. So with this data, we get metadata about the ship. You can see an image there. We also get its type and capacity. And then we get a lot of dynamic data, where it's going, where it came from, where the last port was, where it's planning to go next, the draft and the speed, and also the arrival berth. And so in this slide, you can see a track of a ship called the Bow Engineer going from Argentina to the United States in the Gulf Coast area. You can see the track there on the world map, and then at the bottom, the orange line is actually the speed of the vessel, so you can see when it goes to 0, that's actually when it's arriving at a port. And the shaded area shows the draft of the ship and the change in draft, which can often give our analysts insight to whether it dropped off or picked up material. So we can actually use that trace. If you get down to zoom it in, you can actually see the ship arrive at a particular berth. In this case, the Bow Engineer delivered about 3.5 million gallons to the Westway Terminal in Houston, and that was on September 27th. So we can actually aggregate this data up, and we compare it to what the EIA has shown. So in July and September, there was an increase and a pickup in what we saw coming in from Argentina, about 50 million gallons over those 2 months. We expect October to be less. Most of it, I think, is already landed, somewhere between 15 and 20 million gallons, and nothing more on the water that should be arriving in October based on our analytics so far. And just to wrap it up here, the biomass-based diesel mandate, based on the RVO data based on the proposed RVO and the EMTS data through August, there was only about 500 million gallons that would be needed to meet the biomass-based diesel mandate. And based on the industry performance, the domestic production alone would likely get us there. And on top of that, we're expecting more imports from Argentina, and renewable diesel also make a contribution, as well as imports from other countries as well. And as Scott said, these D4 RINs can also be used to meet the total advanced RVO. Through August, there has not been much Brazilian ethanol imported, but as Scott said, that it could be on the rise because of some other economic factors, and also D3 RINs could play a part there. But it does look like there's still some room for D4 RINs to meet that mandate. In short, though, it appears that the biodiesel market, in terms of RFS, will be well supplied this year, and it may be close if those RINs have to be used for a lot of the advanced mandate, but it still doesn't look like that obligated parties will need to be using their carryover RINs from previous years to meet the 2015 mandate. So I will wrap it up there, and I will flip it back over to Gerald, or actually, no, I'm sorry. We're going to do questions and answer period right now. If you haven't asked your question yet, then please go ahead and send those through, and I'm going to just get started here. Scott, there's a question that came through during your presentation. It says, please describe what yellow grease is.
Well, it's a little bit of a gray area, but typically UCO and yellow grease are kind of synonymous. The best way I can describe it is yellow grease probably has some animal fat in it, or a high majority of it, where UCO should be completely vegetable oil based. They're both higher in FFAs, maybe a little bit higher in MIUs, but UCO should be veg based, and yellow probably has some or a majority animal fat in it.
Great, got it. That's very helpful. And Jake Moline, a question that came through related to hedging. This question says that I'm a supply trading manager for biodiesel and biodiesel blends. How do I hedge the biodiesel HO spread risk? For example, B100 biodiesel held in inventory versus biodiesel blends market.
That's a very good question. Similar to how corn basis is unhedgeable, so is the basis between biodiesel and heating oil. Unless you were to lock that in via a physical contract, that's something that's going to be left open to the market. So if you wanted to lock in a flat price biodiesel out forward for 6 months, you could lock in the basis with whoever you're trading with and go long or short the equivalent gallons via heating oil. But unfortunately, there's no biodiesel futures contract. So it's all traded as a basis to heating oil. So that's something that's not necessarily hedgeable, I guess. Good question, though.
Got it. Thanks for that answer. And, as you were talking about this, one of the things that you discussed is how to you were talking about the capital required to do the hedging. Do you have any thoughts you can share with us about how biodiesel companies address these capital requirements? Something, just asking in a general way, not in a specific way, but seeing if you had any insight there.
Yeah, no problem. Obviously, the relationship with your bank's a big thing, making sure they understand that if you have, $1 million margin call, that's being offset completely by a physical gain on your physical product. That's an important thing for your lender to understand. Even so, biodiesel plants, especially smaller ones, sometimes have a difficult requirement getting the necessary capital to completely run a 100% hedged position. For that reason, Nate here actually was one of the innovators in a program that we call feedstock financing, where INTL FC Stone Merchant Services, the physical trading arm of FC Stone, will help plants in financing that hedged position. So that if you'd like some more information about that program, reach out to us. Nate can walk you through the details of that.
Great. I think that's helpful in terms of practical information, in terms of how people execute these kind of things as part of their business. So I think that's really, really helpful. Another question that came through about feedstocks, and I think, Scott, this one go to you. Do all the biodiesel plants that use soybean oil have the oil delivered, or do some take the soybeans and process on site?
Well, there's some integrated operations where they're maybe making oil on site and shuffling it over to a biodiesel plant. But more often than not, the oil's probably delivered.
Got it. Yeah, it does seem like there are some integrated. There are a handful of integrated producers out there. I know we've got one here in Kentucky. Owensboro Grain is an integrated producer, and they have biodiesel as well as a lot of other products that come out of the crushing process.
There's a few standalones out there that there's a few standalones that you have to deliver it into.
Well, I'm going to stop giving you guys all the hard questions for a minute because I had one that came through for me. So it was basically, the question is, what do you find is the best way to track biodiesel and ethanol exports on a monthly basis within the EMTS site? And I think that really is it's very difficult to do that. In short, I think that one of the things is that if there is a physical export, just so some background for everybody on the call, in terms of the RFS2 program, if a product is exported outside of the United States and it was previously produced and there were RINs generated for that product, then that product would incur what's called an export RVO, so an export renewable volume obligation for the exporter. And that exporter would be required to retire a number of RINs equivalent to the RINs generated for the exported product. The idea being if the product is not used in the motor vehicle fuel supply in the United States, then it's not technically qualified for a RIN being used for compliance. So that's kind of part of the RFS2 rules. And there is a certain time limit upon which those RINs are supposed to be retired once the volume is exported. And I believe, I'd have to go back and look, but I believe the statute's something like 30 days. So technically, if a product has had RINs generated on it and those RINs are exported, there should be a retirement that would show up in the RFS data according to that. Now, the problem is that RINs aren't always generated for product that's intended for export. So if a producer produces a product and doesn't generate RINs on it, then it could be exported, and then that product would never have to have an exported RVO. So you would not see that come in the retirements list, the data that the EPA produces on those RINs. So it's a bit convoluted. It's hard to track in and of itself, just because the retired RINs are not inclusive of the entire export pool. So, Kathy, here's a question for you, and maybe for some others on the panel as well. So if a tax credit does come through for retroactive for 2015 and potentially forward-looking in 2016, what kind of impact would you expect it to have from the biodiesel industry in terms of growth, impact, equipment, those kind of things?
Oh, thank you, Susan. That's a great question. We have seen a number of clients, that are kind of waiting to see what happens there before they make some decisions. I'll go ahead and throw that out to some of the other panel members and see if they have any ideas or thoughts on that question.
Yeah, Scott, you've seen this industry for a while react to the ups and downs of the tax credit. So, yeah. I mean, any thoughts on, what the impact might be if the tax credit comes back retroactive and potentially for a forward-looking year?
Well, retroactive, doesn't do a lot except for the guys that have traded, biodiesel with the tax credit split for this past year or done their own blending. It will certainly, there's some people in the industry that are making that bet that it's going to come back. So, we've seen the last few years that the large producers that have, public earnings, you'll see a large, payment that comes back to them. For next year, I think, if a tax credit comes in, it's obviously a good thing. It can create some blending margin and probably incent some production. The big driver would be if it becomes a producer's tax credit. If that one does, I think that's a real game changer, because you'll no longer incent imported volume. You'll certainly have a more domestic feel, where the domestic producer is going to have an advantage over some of these foreign producers. But yeah, I mean, our industry is still fairly immature. The tax credit is very helpful, and as you can see this year, without it being in place, times can be difficult. It would be a very positive thing for it to come back, obviously.
Right, and it's good to bring it back to the tax credit. Actually, one of the things that was on my docket that I trimmed out of the presentation, was hoping to get a question on it, was the just talking a little bit more on some background on the tax credit. This question was taking it through the credit and how excise tax will be treated down the supply chain, and what markets are most likely affected. That middle part, I'm not quite qualified to answer. There may be somebody else on the Lee Enterprise team that can talk about that excise tax, but I will say that there is most likely, based on our government affairs sources, that it'll probably still be December before there is something that is passed, and so the market will have that time to adjust. The good news is it'll still be $1, and so the value amount will be the same as it has been in years past, all things considered. And so, but it is a good time to educate yourself on changes, like Scott said, if it's a producer's tax credit coming in 2016, what that will mean for your business and what it will mean from your downstream buyers, and just be prepared as much as you can for the change if and when it happens. I think that in general, the change from a blender's credit to a producer's credit, based on the information we've seen, the original reason for this was to limit it to a smaller number of parties. I think that the National Biodiesel Board has quoted something like 3,500 different parties as blenders that are eligible to take the credit. When you limit it to a smaller number of parties, it helps avoid abuse and fraud, and that was the original policy reason for the change in the tax credit. And there are lots of other motivating factors for Congress in addition to that, limiting the tax credit applicability to U.S. producers. could be popular with U.S. citizens and the constituents of our congressmen and women, so that because U.S. producers would be getting those taxpayer dollars and they would not be going outside of the United States, and that's just something that we've heard from our government affairs people as one of the things that Congress is considering. There are lots of opinions on what it is or isn't, but I think it's important for the industry to collaborate and to be patient. The ultimate goal would be to retain the tax credit. And to the last part of this question here, what markets are most likely affected? The tax credit actually covers biodiesel as well as renewable diesel and renewable jet fuel. So domestic markets and potentially import markets for 2015, and we'll see how it goes in producers versus blenders in 2016. But all those different fuel types would be impacted. So I think we still have a few questions out there. I want to take one more question here, and then I'm going to flip it back to Gerald, and he's going to basically wrap it up for the day, and we'll go from there. So this one is for Jake, and Scott, feel free to chime in on this too. How are the majority of biodiesel sales contracts pricing terms set? In other words, are they flat price, HO minus some basis, month average against HO? Is there a standard for that, or how those are typically done?
Good question. Most often, 1 month out forward will be done via flat price. Beyond that, you're going to be trading it as a basis to heating oil, usually a premium over heating oil, and not heating oil minus X. It'd be heating oil plus a basis. Some are traded as an average. It's not impossible to see that, but you'll also see most biodiesel purchasers a little hesitant to go out further than definitely a year, but usually about 6 months is about as far as you'll see most biodiesel traded.
Got it.
Anything you'd add to that, Scott?
Yeah, no, I think that's consistent with what we've seen.
Great. Well, I appreciate all the great answers to the questions, and certainly we appreciate our attendees today for asking those questions. I really think it helps enrich the webinar when we can get specific questions and have some discussion after the fact from the prepared material. So I'm going to flip it back over to Gerald, and Gerald, if you want to take us home, that'd be great.
Sure, thank you, Susan. I want to thank you for hosting the webinar today, and for all the speakers for what I certainly found to be a professional and informative presentations. If you wish to contact any of these experts or other ones within Lee Enterprises, it can be done through their website, our website, and some of the addresses are shown here. This concludes our webinar for today. I want to thank you all for attending, and we hope that Lee Enterprises Consulting gets the opportunity to help make your future biodiesel projects a success. Thank you very much for joining us.